The main adverse impact of ATAD 3 is that it denies shell entities the benefit of double tax treaties and also EU tax directive. So the parent subsidiary directive and the interest and royalties directive would not be available to shell entities. However, the shell entity will still be tax resident in its member state, and that member state can still continue to tax the shell entity on its income and gains.
How does that actually work if the entity is still tax resident then, where it's incorporated and established?
From a practical perspective, the tax authority in the member state where the shell entity is located must either refuse to issue the shell entity with a tax residency certificate, or such certificate must carry a health warning that the entity is not entitled to treaty benefits, and this will prevent the entity from accessing those treaty benefits.
Okay, I see. And shall we talk about how the look-through mechanism works? I think from reading the directive, this is quite unclear.
Yes, it definitely is. Basically, the directive imposes obligations on EU payers of income to shell entities and EU shareholders of shell entities. Depending upon the precise structure, the entity's shareholder might be taxed as if it had received income paid to the shell entity, or the payer might be obliged to withhold tax on the payment. And this might result in tax leakage, particularly as a result of additional withholding tax.
Yes, and clearly entities won't want to suffer that additional tax. What is there to stop them from filing a return saying that they meet the substance requirements and therefore trying to sidestep the rules?
I think really there's two ways that the directive will be policed. Firstly, there will be substantial penalties for taxpayers that make false declarations or fail to submit an annual return when required to do so. And the draft directive actually provides for a minimum penalty of 5% of the shell entity's turnover in these scenarios. Secondly, the draft directive contains provisions for the automatic exchange of substance information by member states. And then there's also a mechanism for member states to request audits of entities located in other member states.
Yeah, that's really interesting. So if a member state tax authority suspects that an entity doesn't have sufficient substance, it could request an audit, which effectively would flush out entities without substance.